Welcome to the 5 and 5 option trading series. We're making 5 videos over 5 days, roughly 5 minutes each, to teach you about option trading. This is day 2 on covered calls and puts. The series is being created by the Weekly Option Podcast. Each week we explain 3 new trades that you can add to your account this upcoming week, and we discuss the results of the trades from the last show. You can find us on iTunes, on Google Play, on Stitcher, and a few other podcast directories. So have a listen. We look forward to having you to subscribe. So let's get started. Covered calls. What is a covered call? Well, a covered call is a strategy where you sell a call on stock that you own. It's a hedged short call position. And basically it's hedged because you own the stock, and it's a short call option because we're selling it. So when it works, you lock in returns on stock that you wish to exit anyway. And it's great because it creates income on stock sitting in your portfolio, not performing. So we call it the landlord strategy because stock ultimately pays you money for sitting in your possession. And it adds a price cushion against the stock price going lower because you've collected money from that option that you sold. So it's great in that regard. And it's also looked at as a yield enhancement measure. So because you get to collect option premium, it adds money in addition to the benefit, the increase in your account from just having the stock go up. The biggest risk is that you still are open to the stock price going down. Now, this isn't incremental. Like, this is risk that you already own from owning a stock. If you own stock in your portfolio, the worst thing that can happen is that the price goes lower. That doesn't change. So it's the same amount of risk that you already have. And because of that, it's one of the main trades that people put on when they're first getting started with option trading. Now let's look at a hedged put. So buying a put as a hedge against stock you own, actually it creates insurance, portfolio insurance for your stock. You own stock, and so the stock benefits when the price increases. And if the stock goes lower, that put option that you own in your account will actually increase in value, just like an insurance policy. So when it works, it allows you to keep the profit of stock from going higher while also limiting any downside price risk. So price goes lower, you're going to make money on the put, and that should offset the money that you're losing in your stock position. The biggest risk, of course, is the price of the put that you bought. When you buy a put or buy any option, your maximum downside is the amount of money that you paid. So if you pay 50 cents for this put, your risk is losing 50 cents on the trade. Presumably, if you lose money on the option, then you made money on the stock. So that's great. And now let's discuss selling a naked put. So we call it naked because it's not hedged at all. So in this, you sell a put, you sell the put option. You do not own any stock or another option against it. So it's an unhedged option position. So why would you do this? Well, when it works, you're receiving premium. So you're collecting money right up front. And if the price goes higher in the stock, or as long as the price does not go below the strike price, you get to keep that money. And if prices fall, you'll get to buy the stock at a lower price than where it's trading now. So let's say you've decided that you want to own Microsoft or Google or IBM or something like that at a 10% lower valuation than where it's trading right now. You could sell the put option, and that will automatically put you in that position. When stock prices go lower, you're automatically going to be buying stock at a lower value. Now, the risk, of course, is that you will have to buy that stock once it goes lower. It's only a risk if you actually don't want to own the stock. You'll be buying a stock that has gone lower than today's valuation. So assume stock is trading for $25 per share and you sell the $23 put. Well, when prices fall to $23, you will own stock for $23. So hopefully that all made sense. If you have any questions, of course, continue to listen to the upcoming videos because they might answer those questions. You can also visit us at theweeklyoption.com or email me directly at eric@theweeklyoption.com. See you in tomorrow's video. It'll be day 3 on option spreads.